Good morning, everybody. Welcome to the Flow Show. It's the biggest day since the last biggest day. We get CPI today, which is the biggest data point since Friday's data point, and then we get the Fed, which will be the biggest event since the CPI data point thing. Morning, Kate. All ready?
Hey, Ryan. Hello, everybody. It's ginormous today, mate. Ginormous. I mean, there's no other word for it. It's everything's going to be decided today. Absolutely everything.
Yep, and then we can all go home. I'm going to Thailand.
Or tomorrow.
Yeah, I'm going to Thailand after I saw that article where they're offering 5-year work from home visas.
I wouldn't put that Thailand link here in the chat box because there's going to be too many candidates. You won't have your spot anymore.
Yeah, they'll take them all up, you rascals. Right, well, lots to get through. We're obviously discussing what's to come up as well. Over in China, some half news. They're looking at potentially banning their banks distributing hedge fund products. When I first saw this story, I thought it might have international ramifications for hedge funds, but it seems a domestic thing that they're just going to limit what banks can offer customers in the hedge fund side of things. But one thing that might play out from that is that you get a bit of money moving offshore. The capital flows out. If people can't have access to those products in China, they may look to seek them elsewhere. So that might have some FX implications. Not that the market's done anything with it at the moment. And we've had some data out of China. Inflation data, they're still picking themselves up off the floor. Month-on-month inflation down 0.1%, but year-on-year coming in at 0.3%, missing expectations, but it's still another positive number, albeit a fairly weak one. I think that is now 3 months of positive numbers. Let me check. It is. Oh, no, I'm looking at the wrong one. Let's look at the right one. Where are we? That one there. It's a bit more than that. I thought it was a bit less than that. So now it's 4 months of positive data. 1, 2, 3, 4. Yeah, so since we got those negative numbers, but they're still looking pretty anemic, but inflation is not deflation. So that's the main thing to take from that one. PPI coming in not as soft as expected, still a negative number. So those influences will still be feeding into the CPI numbers. Over in Japan, PM Kishida says that they need to maintain the wage gain trend outside of pay talks, because all the pay talks are come via the big unions and the big firms, but he wants to see that spreading into small and medium-sized companies that aren't all part or unionized, shall we say. So he wants this virtuous economic cycle to strengthening wages as well. Data from Japan as well, PPI data coming in a little bit hotter for May, which potentially brings some good news, potentially I say, for the next CPI data that we'll get, which I think we might get next week. PPI year on year coming in at 2.4% versus 2% expected, and strongly up on the month, 0.7%. If that's the case for CPI following the trend, then that will be certainly an improvement over what we've seen the last couple of months in those numbers. Over in the UK, the data out from there, GDP data coming in flat on the month. So it's a monthly number there. A lot of fuss and bother about this number today in the UK. Everyone's saying that's not good news for Sunak, showing flat growth and making a political football out of it. But it's a bit ridiculous to judge what the next government is going to be and voters voting for the next government based on a 1 month GDP number, which very rarely strays far from zero anyway. The 3 month rolling number came in at 0.7%, that one there. So that's all like a rolling quarterly number, which obviously looks a bit better on when you look at things in that light, but still anemic growth, as we know here, Eurozone, elsewhere. All the numbers coming in with 0 points on the start of them, so still not looking too good. Industrial production went backwards a little bit in April, down 0.9% month on month, was expected to only fall 0.1%. Industrial production down 1.4%. Blame it on the weather, as always. That's most likely why we're getting these soggy numbers. Over at the ECB, the old wafflers continue. ECB's Villeroy says we are gradually emerging from an inflationary crisis. He's now become an arch expert at forecasting, saying inflation will be below 2% in France starting next year, even at 1.7%. Don't worry, I've bookmarked that. We'll see what the numbers are. ECB's Lane is still banging on about wages, reading from his report he wrote 2 years ago. He's still reading through it. ECB's McClough says future rate decisions is not just all about wages. We need to watch particular risks from global and European conflicts. He's not uncomfortable with the market pricing of a little more than one rate cut in 2024 and 90 pips by the end of 2025. ECB's Kazakhs says there's a hope of more rate cuts this year, but it's better to lower rates step by step. Over in politics, in the Netherlands, the right-wing leader Wilders have finally agreed, or political parties have finally agreed on the formation of a right-wing cabinet. So they're getting their act together over there, one of the countries who did swing to the right some months ago. And it seems we're getting that shift from a lot of other countries, as we've seen from the EU elections. PIMCO, they're talking their book, say at a certain point, fringe bond spreads could become attractive, potentially not too far from here. That likely means they've already loaded up. They also expect more regional bank failures in the US, so they're probably all short. The IMF, the International Monetary Fools, are telling everyone what to do and how to do it as usual. They say Canada should tighten policy and the BOC could communicate its expected policy path. Not sure what they're banging on about that, but they're as good as forecasting as a lump of coal. Okay, you got anything, comments on that lot, or anything you want to add?
IMF is I guess that head strategist wants to replace Lagarde as the next ECB head, I guess. For the rest, I don't have anything to say about the IMF. I mean, they're mostly statisticians, right? So when they come out with their findings, it's all based on a lot of statistics, which is, let's face it, largely ignored by how the market trades it right now. They used to have a bit of more impact. I recall IMF and OECD reports back in the old days, where actually markets may move a bit on it, but nowadays they're just their forecasts and statistics are just shrugged off, because most of the investors have their own statistics and models built around their own statistics. So I mean, I don't think the IMF has much of a say in whatever anyone wants to do. On the rest, no. The Chinese thing about the ban on distribution of hedge fund products, yeah, as you say, it may actually have an inverse effect, because it is clearly meant at keeping money at home. If you don't offer hedge fund products, which are usually a fair part of it is external investments, they probably want to keep the money at home. But if you put a ban on it, maybe that in the very short term it can push people to get outside with their cash, and then I'm thinking again, perhaps stuff like gold also, but they can buy with their own money, but don't need hedge funds for that. But yeah, there may be a bit of flight of capital in the short term, but I can't really say that CNY, CNH is really driven by that right now, but they must see the internal data, right? Yeah, and well, if you were completely through the news, I think I don't know if you have anything else to talk about the shenanigans in Mexico continuing.
Oh yeah, got the Mexican headlines to get through.
Scheinbaum is on the same line as AMLO, because I mean the thing over there, which to me is a bit worrisome, is not really taking away that oversight. Of course, taking away the oversight of the government means that they can do stuff more easily, but it's what they will do with it, and that may be really anti-investors, and the investor market is really not liking what they are doing right now. That's for sure.
Yeah, I didn't scroll down. I missed those headlines. Yeah, we had further comments that these reforms are going to get pushed through yesterday. So that's given Donamex another lift up. Well, it gave it a kick up to 1865s, and we own another kick up through it today. We're finally breaking that 1850 level, and it's already tentatively becoming support, as you can see there, just on these little 2 hourly candles we've got there, holding the line. Really, next level for me is way up 1920s, the 50 fib of this move. So I'm still long a little bit. I'm running out of my blades, having to get thinner and thinner for the slices, but I'm trying to stay in as long as I can. But 1920 is the next one for this. Also, on that political front, KD ANC seem to be getting a deal done and working things out.
Yes, Ryan, it looks we are steering towards that. We are steering towards an ANC-DA coalition, at least as the 2 main parties. I don't know whether there's going to be more announcements made on Friday and into the weekend when the parliament will reconvene. So that looks to be where we're heading. The rand has benefited from it a little bit, but then you exactly stay on that 1 day chart, because it's like an electrocardiogram, and it's going up and down and up and down and up and down, but it's not really taking any major direction right now. I am still of the view, but of course I can be wrong, that once all this positiveness about new coalitions and whatnot, when Parliament reconvenes, I don't know exactly what they are going to decide, if they already make any big decisions. But I think that the positivity around it will sooner or later start to wane, because I've read also on the other side that ESCOM is already struggling again to keep the grid up. So I don't see this lasting. Now, of course, we always have the dollar in the equation, so I'm not ruling out that today, if we get any weak US data or a non-hawkish Powell or so, that we could see a bit lower. But I'm ready to counter any more deeper moves in the dollar rand, to be honest.
Yeah, cool. Thanks, mate. Right, let's take a look at what's coming up today from this CPI data first and foremost. So we're not expecting much change. CPI to come in unchanged year on year at 3.4%. The core to come down 1 pip to 3.5%. Now it's important to look at the trend in these things, and I'm often pointing out how long the headline CPI has stayed at this level. This will be the 12th month above 3%. We haven't got lower than 3% since the big drop from the highs. So that is showing you how sticky things are. But on the core, it is continuing a slow trend. The trend has slowed, but we came off these highs up near 6.6%. So we have been slowly dragging down. The question is, at some point, what is going to override what? Is the core going to keep coming down below CPI? That would be quite unusual. So one would think that maybe we're going to start to see stickiness just purely from all that sideways action in the headline CPI translating into core CPI. So it's never a linear thing, and there's always a bit of a lag between the core and the headline. Irrespective of whether the Fed looks at PCE, and that's their preferred method, and what that's telling them, the market is going to move on this CPI data, because it's the only thing it's going to get before tonight's FOMC. So we're going to have the usual thing where the numbers will come out, the market will move, then the propellers will get their calculators out and their abacuses, and they'll go through the numbers, shelters, super cores, rents, all the lot. And about 15, 20 minutes later, we'll finally find out whether it was good or bad or what. So I think the usual rules are going to apply to this one. Okay, it's pretty simple. If CPI comes in softer than expected in both metrics, then obviously cut expectations are going to rise. The dollar will get sold. Yields will come down. If it comes in, I think even if it comes in on the money, unchanged, you're still going to see this current sentiment of a bit of dollar strength maintaining. If it comes in higher than last month, in either or both, then that's going to get a stronger dollar reaction as the market increases the likelihood of the Fed staying on hold and the dots changing to indicate less hikes this year, and the potential even for a risky stray dot or two moving to higher rate levels. I think that's a bit of an outlier risk that we might get from maybe one or two of the arch hawks over there. As I say, outlier risk, not a base case risk. So yeah, these numbers are going to decide the expectations going into the Fed. And then from there, we just have to decide what is Powell going to do with those expectations. Is he going to pull the rug out again like he did last time and say, we're not thinking about hikes at all? Obviously, it's in the toolbox, etc., etc., ready to act on both sides of the mandate. And we're just going to stay higher for longer. We keep playing this game where the data keeps testing the narrative. At some point, one is going to have to give. It'll either be the Fed or it'll either be the data. And we don't know what that's going to be. So, yeah, the risks are pretty binary for this. So, but you've got to trade each part, trade the CPI data, and then think about what you're going to do if you're in a trade going into the Fed, whether your position is going to be at risk of going the other way or increasing your profits further, or just take each event separately, have a little snipe over the CPI, and then react to the Fed once we get it. Personally, I think the Fed are going to stand pat, but my thoughts are very loose because until I see the CPI, I don't know how they may react or change. So I can't really say anything until I see those numbers. But on balance, I think the Fed's just going to keep the same message, not let the market get their hopes up for hikes. And that might be a bit of a disappointment trade for what we've seen since the NFP. And then we'll see a bit of dollar selling. Kay, your thoughts, mate?
Well, first of all, we are back into the scenario where the market would love to see the weaker CPI. It's like regular before each data point. The market tries to gear up for weaker data, and then on the CPI, we've seen a few of those forecasters in banks really go down to the nearly third digit now behind the comma and trying to figure out whether it's going to be 0.24% or 0.26%, which would change the core CPI from 0.3 expected to 0.2 expected, and that's going to be a big change. I think this CPI, you have to look at how it evolves. If we continue to come lower, yeah, the dollar will probably be sold. I'm looking at the combination of CPI and the FOMC today. Just to figure out what's possible on the FOMC, because obviously they will have the number. Now I don't know whether they will already have voted in the dot plot before the CPI or after having seen the CPI. I guess after having seen what the CPI comes out, but I'm not even sure. Yeah, for me, I'm trying to simplify it. I say if the CPI comes out really weaker, I think the FOMC will be overlooked, regardless if the dot plots are showing only 1.9 cuts or 2.1 cuts or 1.6 cuts or 2.2 cuts. I mean, it's going to be obsolete. It's going to be much more interesting tonight if CPI comes in line or stickier, because then we may end up with a scenario that we have seen last Friday, where the market is kind of forced to buy dollars, and the market is hates to buy dollars these days. And you can even see it in the bond environment as well, right? We've seen that the bonds are like just slipping and sliding a little bit lower into the CPI and the FOMC tonight. So the whole market is actually looking for when is this really going to turn. So there would be nothing more painful is perhaps a too big a statement, but the market doesn't like to force dollar buying. So that may be your surprise trade-off tonight. And if that CPI comes in sticky. So that's a bit how I look at it. Then, and then, as you say, there may be a trade quickly on the CPI and then see what happens on the FOMC. But I think we need to take both into consideration. And I also think that the more medium-term players, they will still have this jobs report in mind, and then take the CPI and the FOMC together, and as a result, we may see pretty decent moves in the second half of this week for everything dollar related.
Yeah, very much, mate. So long and short, it could be a bit messy, is what we're trying to say. Now, everyone's going to be looking at the dots. Obviously, we're not getting any policy changes. The expectations for the dots are that they move to at least a medium of 2 cuts. We're currently at 3 cuts. The market's already on side with that. We've heard from enough Fed members saying that the dots are going to shift. Maybe a bit more hawkish. There's a lot of people even expecting it may move to 1 cut median this year. So those are the expectations. Anything outside of that is either going to be a little bit dovish or far more hawkish. Our golfing mate Mark in the chat room did the sums, and he says to move the 2024 medium dots to 2 cuts would only take 1 person to shift to 1 less cut. For it to move to only 1 cut, it would need 5 people to shift to 1 less and 1 person to shift to 2 less. And then he says for the 2025 dot plot, to move to 1 less cut would take 6 people to shift to 1 less cut. So it just gives you an idea of how many dots need to shift. But for the most of us, it's not really about counting who shifts, it's about where they shift to. So we'll just look at the dot plot and see what happens. And then separately to that, we've solved the riddle why there's 1 less dot in the longer run than there is in the other years. And it's Bullard's fault, long and short. But if you're in the chat room, check out the flow room for that that discussion, keeping us busy this morning for want of something better to do. So yeah, I think that's the Fed cover. If you've got any questions about the Fed or CPI or anything, put them in the chat function here on Zoom. Let us know what your thoughts are, or any questions you have. Yeah, Ali, I'll show you that dot plot actually. Might as well do it. Give me 1 second. I should get it up. Boom, boom, and there we go. So this is the last set of dots from March. Okay, so here's where we're sitting, the median, sitting around the 3 cuts mark. So that shows you how those have got to change to move up. So we're probably going to see or the market's expecting to see a shift up in all these dots across this. So that the dot curve, if you like, is potentially going to be shifting up. It's just the magnitude of those dots shifting if they do. You got the likes of I think this is cash and carry, isn't it? Floating around up here at the high ones, Kay.
Yeah. So even Bauman.
Yeah, he's moon shooting there for cash carry. So yeah, that's what we're going to be looking at. It doesn't really matter where they go to in terms of the rate number. It's just what it's going to indicate. So we're expecting 2 possibly 1 medium for this year. And as I say, if it stays at 3 or if it goes less than 1, there's going to be a dovish or hawkish reaction depending on that. So that's the outside moves, if you like, for that. Yes, mate.
It would be really funky if it stays at 3, because that means that whatever all the Fed members have said so far was absolute crap.
Yeah, exactly.
So it's virtually impossible it stays at 3. That would be like incredible. The same thing as ECB wouldn't have cut earlier. So that's virtually impossible it stays at 3. Yeah. The question is whether it stays below that 5% line or goes back above, and that to make it simple for Ali and others. That is where it's going to matter. That 5% line below and above.
Exactly. But this is trading. Virtually impossible doesn't make it ultimately impossible. So it's still a potential risk. Even if it never happens, if you know it's a risk, then you know how to react quicker if you do see it. So yeah, that's what we're expecting from the dotty dots. All good fun. The stuff they have to put us through to get monetary policy across. Right, let's have a look at what's going on in markets. And again, let's start with something like the euro. It's a pretty binary affair, I think. It's just going to be a case today of reacting. You know, if you're in trades, if you're in profit, you might want to look to protect some of that profit. You know, bring your stops up. So if you get a data point of the Fed that goes against you, you're not going to give back any gains. And if you bank some money, then it's sitting in your pot, not giving it back to the market. But otherwise, really, days like this, I just look at my ranges. You know, we're quite close to this 107 with this big data. The Fed, I might sort of not rely on that level too much, only being 50 pips away. Obviously, we've got bigger levels down towards 106s. Again, 108s. It's been a bit of a level, but again, we're pretty close. So I'll probably look more sort of my zone up towards 109. So I'll set my boundaries there at those sort of levels, 106, 109. Because we shouldn't get anything that's too strong either way. So if we do get a decent move, these are the likely stretch points. If we couldn't get through that over all the other stuff and data and whatever, and we couldn't get through that over all the same sort of stuff, that tells me that's where the market is likely to run into trouble if we see those levels, and then I'll look for a possible counter trade just to play the ranges. So that's really what you should be doing today. Getting over your charts, pick the levels you want to trade, make them more sort of reactive after you know the news, you know the data, because it can be quite tough to grab a trade sometimes as that stuff's being announced and dropped. So plan is the advice I've got for you. Cable, if you're looking. Again, we're a bit in the middle, 128, so that's been a big level, 126.70s, 127, been a big level as well, but it's very tight for cable. You know, cable can easily do 100 pips, 150 pips on big news. So I'll be looking a bit wider, probably up towards 129s, down towards 126s as a bit of a wide mark. A couple of trades I'm in. Yeah, go on, mate.
While you stay on the cable, while you're on the cable, I think so that'll avoid people to have to look at my spaghetti charts. I think in regards to the sterling, it's still behaving pretty well, and also it could have reacted a bit more to this morning's data, but it didn't. So that to me still seems a pair that if the dollar would start to weaken this afternoon and into later tonight for us, this one is a good candidate to go for a walk higher again. This is one of my pairs that I'm actually scrutinizing right now. If we see a bit of a breakdown on the dollar, because it's just the fact that the sterling is still behaving pretty well. So just wanted to pick up on that, so it'll avoid me to take more time to show my chart. This is just I always like to look at which pair could do better in which scenario, and I think sterling is one of those pairs that could do pretty well on the cable if we see a bit of a weaker dollar today.
Yeah, very much so. And I was actually going to move over to one of the ones I'm looking at for that as well, which is the Kiwi, which I
Oh yeah,
traded
I love
after
that one too.
the NFP. And yeah, if you compare the two, compare that to the Aussie, you know, it's similar patterns, but the Kiwi just seems to be
Different levels.
seeming to be a bit more stronger than the Aussie dollar since the turn of the RBNZ, which you can obviously reflected in Aussie Kiwi as well, which is staying below that 108 magnet line that we've got going on there. Sorry, Kay, was you saying something else?
Yeah, I mean the Kiwi definitely is a bit stronger. So there's a bit of differential in the interest rates on the one hand. Aussie is a bit of a laggard versus the Kiwi, and also don't forget that next night for us in the Aussie morning we will have the Australian jobs report coming out as well. And
Yeah.
perhaps there may be a bit less interest also in the Aussie, because the market may want to wait for that jobs report to come out later tonight for the US, early morning for us.
Yeah, absolutely. And also the Aussies are a bit more commodity related than the Kiwi. And so if you're seeing gold looking a bit weak, that can have a bit of an adverse effect for the Aussie as well. So there's a couple of trades. I mean, I'm long Kiwi from 61.70 down to the big figure. I don't know what to do with it. It's, as I was saying earlier, I'm in a trade where I could get whacked one side or the other over the data. Do I want to take that risk, or do I want to get out? I can get out pretty much at break even or with a pint of beer on it. So do I want to go in with a risk? It's a punt if I'm just sitting in the trade waiting for the data and the Fed. But then again, I sometimes like a punt, and I can see which way it wants to go. So I still fancy this one, even if the dollar is a bit stronger, because I think longer term, I don't see the Fed turning to hikes. There are some yellow flags appearing in certain parts of certain sectors, you know, like we've seen with the jobs market in some of the PMIs, although there was a bit of improvement from the ISM. You know, jolts, we're seeing pickup in challenger layoffs, that sort of thing. But then you look at the claims and that's all tickety-boo. So there's no wholesale flags being waved, but there's more little ones popping up than there are places that don't have flags, and it just means I think we may just be heading for a little bit of weakness. I don't think we're going to be seeing any big collapses, but we could just see a bit of softening. We've already seen a bit from the GDP numbers as well. So is that enough to shake them into cuts? Who knows? But it's certainly evidence suggests that they won't be looking to hike anytime soon unless there's a big shock in inflation. So yeah, I'm happy to still be a dollar seller, a choosy dollar seller, shall we say, until something changes the other way. I've looked at dollar MEX. Kay, do you want to take it over? Maybe have a look at the Loonie. You haven't looked at that for a couple of days, I don't think.
Yeah, I can have a look at the Loonie, and then there's a person asking for the Euro Kiwi. I can do that too. First of all, I'm going to have a quick look at what's happening in the S&P, because I'm in this one from last week as well. Bought it just around here when we started to move up again. I've been lightening up my position, lighting up. Well, yeah, lighting up. I guess my English sucks really. Because we were at the top end of this wedge, so I've got paid out again this morning. I'm in CFD, so it looks that different than this one. But this one is another example of the market still being very positive towards equity markets, towards risk in general, and also looking for a slightly weaker probably CPI, the interest rates not moving too far away from where we are. So this one could react on a much higher CPI and come back into the wedge and perhaps correct a bit down to low 53s, 53 and a quarter or so. If in turn we're staying on a slippery slope in the CPI. This one is probably going to need an extension to it. Then I'm looking at 5440s, and why not 5500 on the S&P? Okay, so if we get a bit of a weaker print on the CPI, I think this is in for another rally. I've got a little bit left. Not a lot, but I'm keeping a close eye on affairs. If we get a sticky CPI, watch out for the reaction that we would have around this 53.25, 53.30 on the S&P first of all, okay, and then over to the FOMC. If we would be close to here due to a much higher CPI unexpectedly, then we need to watch out what the FOMC says, because they could take it all the way back down to 52s. But in the meantime, this is still very big, so that was worth having a look at. Yeah, dollar CAD is a bit of a it's broken up. I think it's broken up, but we are hesitant around 137.40.50. Okay, this is a bit of a level here. That this 137.5. Let's say this. So this is going to depend on what's happening on the dollar this afternoon. If we get a bit weaker one, don't be surprised that we would retest 137 for a starter, and then watch the reaction over there. If we get a sticky CPI, retest of 137.90, and I guess a gradual move up into the 138s could be expected. That's for the levels on the loonie. If we really start to break under 137 and hold below, and then we are back into this whole zone here, traffic zone, and then I'm not sure. It could be. It could be that the dollar really weak is this afternoon. It could be, and over the FOMC, and then you're really looking at deeper levels again, perhaps low 136.5 to low 136. It's all possible, you know. But let's see first if 137 gets tested and holds, if that were to be the direction. Euro Kiwi, good question by Mr. or Mrs. See it. I am a little short on this one, because I think that finally we've broken this triangle on the Euro Kiwi. And so we tested the 88.8 here in the 174.70s. It's going to depend on both ends, okay? Because the Kiwi is a slightly higher yielder than the euro, and we know about the European political situation right now. I do, and risk is still doing okay, as I just showed on the S&P, for instance, which is which is valid for a lot of equity indices. So this one likes risk. That means that a bit lower risk. Add to that the European political situation. I do think that there is a fair potential that we are going to revisit those December lows. That's what I'm looking at. If I get it, I'll be happy for now, and then reassess. Likely take most of it off, and then reassess when we get down there. If we get back above 175.5, then we are back into this triangle, bit more range. Look at what's happening back up in the 176s. Then it moves relatively quickly. There are, in between brackets, relatively small peeps. So this moves quite a bit around. So yeah, watch that 175.5, 175.60 for when it returns over there. If we retest and then start to go back down, then we are really in the game for a move down to that 173s, I guess. There is one that starting to sorry for starting, the yen is starting to worry me a bit again in getting into the Bank of Japan later this week as well, because we are seeing it's coming back up a bit too easy. And as much as I'm looking at the cable for trading a weaker dollar, I'm looking at this one to trade a stronger dollar, because it does look to me that the Bank of Japan, that the reduction, and I'm not going to say it's a done thing on Friday, but it's a high possibility that they at least plan for a reduction in JGB buying, and it'll depend on the outcome. But most expect a reduction from 6 trillion per month to 5 trillion per month. So that would bring the net buying under the total of the redemptions that we see year on year. But the market is shrugging it off, and I don't. If I would be long yen, I wouldn't like this. I can see the yen pairs, stuff like sterling yen already back above 200, and stuff like Aussie Kiwi yen and things that it's just gradually pushing up again. So this one, looking at how the market has been trading it, this one could go for a ride if we get a sticky higher CPI and a relatively hawkish FOMC. I think this 157 3/4 may be toast, and even before we hit the Bank of Japan, we could be already back at 159. This is just the one that I'm looking at. I said before, the jobs report out of the US last Friday, I said if it comes in really strong, we could be trading 157, and so that's what it did. And then looking at the reaction that we had post on the whole of this week, even when the rest of the dollars are correcting a little bit, dollar yen is not enjoying, the dollar yen is not coming back down. And we all know what it means. If it doesn't come down, it most of the time only has one direction to go, especially in the yen, you know. So this is one that I'm looking at for the other side. I'm just now looking through the comments that you have. Rick saying if CPI is strong, first move may be up in dollar, but long-term dollar. Okay. I see, Ryan. You reply to that. Is there anything else you guys want to look at before I close my books? Yeah, I just want to show dollar Swiss because it's an interesting one. Yeah, Ali, I told you what I think about the dollar CAD, right? In case the one and the other happened. What is your trade? You're short dollars, right? You're short dollars. Well, yeah, I mean, if it's a stronger number in this afternoon, I think your stop shouldn't be too far away and should be yeah. I mean, it's all depending on the dollar this afternoon. If you want to have a position ahead, I mean, I'm small long Kiwi CAD now through mostly Kiwi CAD through. I'm long Kiwi CAD, Kiwi Swiss, Kiwi dollar, short Euro Kiwi. I'm a little bit long Kiwi for now, but on the Canadian dollar, I'm rather a tad short. Look at this dollar Swiss. It's turning around the bottom of the daily cloud. So this one, 89.80, guys, today, 89.75.80. We are not far away. I think this could be an interesting one to watch on the close, whether we are below or back into the cloud. And then if we are back into the cloud, then you look at 90.0515 for confirmation. I think if 90.0515 goes again on the dollar Swiss, then we start to trade higher again. I just wanted to point this one out on the dollar Swiss. Sterling CAD. I don't think I have it charted, but that's looking big to me. Whoops, no, that's not what I wanted to do. That's looking a bit big to me. Oh, that's actually looking like a nice one, huh? Broken above a wedge or a near triangle, 1, 2, 3 levels, and it's breaking up. Oh, there seems to be a bit more weighting here, but if you even look at the more medium term, look at that. That looks constructive, and which is a bit in line with everything that we see on the sterling as well, right? Of late, and we are around the long term, turning around the 50% as well. Michael, This one look constructive to me. It does. Okay, this is the trust move, but if you look at this one here, well, you're turning around the 127.2. Yeah, this looks constructive for as long as we stay above 173.30 for a stop. Oh, it's a bit wide. Okay. But anyway, medium term 173.5 and 172.5 is okay. But for as long as you are above here, this looks quite constructive medium term. Cat Swiss, I don't think I have ever watched it, you see. Coming down a bit, this is the cat weakness that we have seen since the Bank of Canada, and then in conjunction with what we've seen on the risk of play, that the Swiss strengthened on the European situation as well, right? And we had a little bit of a warning on from Jordan as well a while back, but I do think that that Swiss strength, not saying is coming to an end, but I'm keeping a close eye on. If you look at this looks like flagging for a move lower. So watch 65 the figure, 65.40-ish. If you get back above 65.5, the party may be over, and this could move a bit higher again. If in turn you start to break that flag again, 64.60s, which is also your prior low here, Canon. 64.60s, mate. This is where we could be heading to if we break below. And with that, I'm going to give it back to Ryan.
Thank you very much, mate.
Guys.
Yep. Thank you, everyone, for coming to the flow show. We've got you set up well enough for the FOMC and the CPI data, know how to react, what to do with the numbers. You can always check us out on the F.A.C.E show a bit later, or come and have a chat to us in the chat room if you like. Have a great day, everybody. Please stay safe over these events. If in doubt, stay out. You can always pick up the pieces afterwards. The markets will be here tomorrow, so don't get caught out with anything. Have a great rest of your day, and we'll go over everything tomorrow morning. Have a good one.